The goals of OPEC often conflict with the economic aspirations of a large portion of the world's population, especially those nations who are net importers of crude oil. The goal of OPEC is to increase the value of its members' crude oil reserves. Generally speaking, this is official government policy. Compare that to US government policies, which typically center on the goal of stable but low energy prices. The goals of the US government and the US oil sector are frequently at odds, since that isn't always what US oil firms want. The objectives are the same in OPEC nations. The majority of these nations' governments' income is frequently derived from the selling of crude oil on the international market. Thus, OPEC aims to maximize oil prices without contributing to global economic downturns or incentivizing competitors to increase their output or engage in environmental conservation. In addition to attempting to preserve or increase its share of world oil production and export volumes, OPEC seeks to regulate supply in order to affect prices. Its capacity to influence the market is compromised if it loses too much market share. OPEC could more readily accomplish these goals before the US shale oil boom. However, because of the US oil production boom, OPEC can no longer support prices without also increasing US production incentives. As a result, the cartel's influence over price has diminished. Even yet, in 2022, OPEC and its allies produced over half of the world's oil and had more than 70% of the proved reserves. As a result, they continue to have considerable impact over oil prices around the world. However, it's frequently compared to steering a large ship. The market takes time to react to OPEC's activities. If OPEC sticks to their output reduction announcement, some of the extra supply will eventually run out. OPEC's production cuts are partially countered by non-OPEC nations like the US, who are boosting their output at the same time. It resembles an arms competition between the US and OPEC, and thus far, the US has mainly been successful in raising production levels sufficient to offset the majority of OPEC's reductions. To sum up, output cuts have been used by OPEC as a political tool. For this reason, among others, I anticipated that the cartel would reduce output, and given the approaching presidential election, they might do so once more in 2024. I believe that OPEC members like Saudi Arabia and allies like Russia would want to push prices higher in the run-up to the election because they would like to see Donald Trump re-elected. This will be interesting to follow in 2024, since it will make it more difficult for President Biden to gain re-election if gas prices are rising sharply before the election. According to OPEC's monthly report released on Wednesday, the organization's production of crude oil decreased in November for the first time in several months as U.S. oil output kept rising to record highs. According to OPEC's monthly oil market report, MOMR, total OPEC 13 crude oil production averaged 27.84 million barrels per day, BPD, in November 2023, a 57,000 BPD decrease from October due to lower output from Iraq, Angola, and Nigeria. According to secondary sources used by OPEC to monitor its supply to the market, crude oil output in Kuwait, Venezuela, and Libya, all of which are excluded from the OPEC Plus agreement, rose month over month. The cartel's top producer, Saudi Arabia, raised output somewhat to 8.998 million BPD from 12,000 BPD. This is consistent with the kingdom's commitment to pump about 9 million BPD as part of its voluntary cut of 1 million BPD, which was extended through the end of March 2024. The Reuters poll from earlier this month, which revealed that OPEC's oil production fell in November for the first monthly dip since July due to weaker shipments from Nigeria and Iraq, is consistent with the official OPEC production figures. In addition, U.S. production of NGLs and oil and condensate also continue to rise to all-time highs, according to OPEC's report. September saw a record-breaking 21.6 million barrel per day of U.S. liquids output as a result of ongoing production outperformance, both onshore and offshore. OPEC projects a 1.3 million barrel per day increase in U.S. liquid supplies by 2023. According to the cartel, growth in the non-OPEC liquid supply is still expected to reach 1.8 million BPD in 2023, with the US, Brazil, Kazakhstan, Norway, Guyana, Mexico, and China leading the way. OPEC stated that oil futures prices experienced a significant downturn, marked by heavy sell-offs amidst a highly volatile futures market, in a statement regarding changes in crude oil prices in recent weeks. The cartel stated, exaggerated concerns about oil demand growth fueled the market dynamic and negatively impacted market sentiment. In an attempt to drive up prices, OPEC shocked the oil markets in April of this year by proposing more production restrictions. It is true that prices increased. Nothing could be done to stop them. Demand was strong, supply growth was moderate everywhere, and U.S. drillers were occupied with paying out profits to shareholders. In December, the oil market is more volatile than ever, OPEC is running out of alternatives, and the 1 million BPD increase in U.S. oil production is the talk of the town. The growth in U.S. oil output seems to have been the biggest surprise of the year, along with the most recent conflict in the Middle East. Analysts predicted back in April that U.S. shale drillers would not dare consider production expansion too much and would instead stay focused on capital discipline and shareholder returns. The CEO of Ovintiv stated at the time, as reported by Bloomberg, "We're now into several years of players like us running these businesses for returns and free cash flow, and that's not going to change in the short term or the long term." Reputable oil trader John Arnold stated in April that the U.S. shale oil sector's incapacity or refusal to grow at the same rate as it did from 2016 to 2020 was the only thing that made the OPEC cut conceivable. The prevailing viewpoint on U.S. oil for the majority of the year is essentially depicted in the above. Additionally, drillers were subtracting rigs during the most of the year as opposed to adding them, which added credence to the prevailing viewpoint. The reason for this was as follows. At the time, Peter McNally, global head of energy at market research company Third Bridge, told Bloomberg, the U.S. is unlikely to fill in the OPEC gap anytime soon. Those producers who committed to more aggressive spending plans have been punished by the stock market. The U.S. produced 13.2 million barrels of crude oil in September, according to the most recent EIA figures. The EIA predicted production for the fourth quarter of the year at 12.5 million BPD a year ago. Production might still fall from the September record, of course, but not by this much. American shale shocked everybody. Everyone was taken aback by it because of the production. While the world watched the weekly count of active drill sites, which has decreased by 20% so far this year, the operators of fracture seals focused on advancing their technology and drilling methods. And it was fruitful. Not one, but 5 major producers of shale oil reported better than expected well productivity back in August. Occidental Petroleum, Diamondback Energy, Pioneer Natural Resources, Ovintiv, and Chevron all reported that their wells were yielding higher than anticipated production. The surprise that is currently engulfing everyone suggests that the news was generally disregarded. OPEC is running out of alternatives, thus analysts are likely addressing their preoccupation on the rig count with increased attention to reports regarding well productivity improvements. U.S. shale benefited from the cuts that were put in place earlier this year. They increased returns and perhaps even appeased shareholders by maintaining prices at comparatively high levels. Additionally, the boom in exports was fueled in part by the relatively low cost of U.S. oil. According to the Energy Information Administration, U.S. oil production will expand much more slowly in 2024. From an average of 12.93 million BPD this year to an average of 13.11 million BPD next year, it forecasts this rise to be merely 180,000 BPD. Just as it had good reasons to anticipate the production rate for this year last year, the EIA must have good reasons for this prediction as well. Predictions are subject to change. They always make a number of assumptions, one of which is the assumption of progressively slower increase in the demand for oil, which is why they frequently prove to be incorrect. Still, the demand for oil has consistently outperformed predictions, much like U.S. shale drillers. According to BP, it should have peaked in 2024, and the IEA predicted that it would slow down significantly this year and the following. Rather, demand reached a record high this year, and the IEA revised its 2024 projection, indicating that a slowdown in pricing would now force demand to expand more quickly. As this is going on, OPEC is actively growing. This is an alternative to a price war because it aims to increase the number of major oil producers who can join production control programs in order to increase their efficacy. But if U.S. drillers chug forward with their longer laterals and quicker well drilling durations, OPEC would be left with no choice but to engage in a price war if the expansion plan falls short of expectations. Is it still a safe option? Let me know down below. If you want to continue to learn about business investing and financial education, we have got this video waiting on the screen for you to check out. Don't forget to give this video a like and subscribe for more videos like this. Thank you so much for watching, and I'll see you in the next one.